Hi guys, I'm a Forester here and thanks for stopping by. I hope you'll find this video interesting. I know I enjoyed putting the material together for it, but it's how to recession-proof your retirement portfolio. Now, I'm 70 years old. I retired in June of 2025, just 4 or 5 months ago. And every day I feel like brings us one day closer to the next recession. And so this is a topic that's of great interest to me. Now I'm going to break this video down into 3 segments. I'll try to go over it quickly, but there is a lot of information. So the first segment will be talking about my investing history, or saving for retirement and building our retirement portfolio, and how our goals have changed from the beginning until now. The second part will be looking at the risk of recession, and the third part will be looking at our portfolio and how it positioned us to hopefully weather the next recession. Okay, so let me launch into a little bit about my investment history, and then we'll go to the tabletop to look at some data. So I worked for Boise Cascade. I started working for Boise Cascade as a forester in 1979, and my first interest in investing was very simple. Boise had a pension plan, but they also had a matching contribution to a 401k. So they matched up to 6% of your salary, dollar for dollar. So I immediately contributed 6% of my Boise Cascade salary because I could double that money immediately. Now, I didn't give quite as much thought to how to invest it though. It was in stocks, but I put it all in Boise Cascade stocks. I felt like I had my fingers on the pulse of the forest industry, or at least Boise Cascade, and Boise was a cyclical company. Their stock would reach a high of over $30, just a little bit over 30, and a low just a little under 20. And it would go back and forth over a period of several years. So I would buy Boise stock when it reached under 20, and I would sell it when it was over 30. And I did that several times over the decade that I worked for Boise Cascade, and I did okay. I just went back before I made this video and looked, and it took me 14 years to save my first $100,000, and that was with Boise Cascade stock. So 14 years. Now salaries were much lower back then. I don't remember the exact salary I made when I got out of school and started with Boise, but it was somewhere between $13,000 and $15,000. So inflation was pretty big back then, and so salaries rose a little bit fairly quickly, but the beginning salary was somewhere around $13,000 to $15,000. So when I left Boise Cascade, we, about that time in 1988 actually, we were 2 income. My wife worked and I worked, so we had 2 incomes and no children. And so we're in pretty good shape. But then our daughter was born, and my wife decided to quit her job and stay home with our daughter. And just immediately after that, within a month or 2, Boise Cascade made the decision to sell off 500,000 acres in the Carolinas and sell off all their mills. Now I had the option to move to Alabama, Louisiana, or International Falls, Minnesota, and stay with Boise Cascade. I chose to stay in the Carolinas and left Boise. So we went from 2 incomes and no children to 1 child and no incomes in a very short period of time. Don't feel too sorry for us, because I left Boise Cascade on a Friday in August, and the last Friday in August, and I went to work for the state of South Carolina on the next Monday. Now when I started with the state, I had decided that I was not going to contribute anymore for a period of time to a 401k. So there was a decade there where I didn't contribute anything. My wife was staying at home. We needed my income to support the family, to pay for some of our needs, and I carried on second jobs on the side to pay for some of the wants. So my salary covered the needs, and second jobs covered the wants. There reached a time though when my wife did go back to work. It was after 10 years at home, She went back to work, and somebody that I trusted and respected for their financial advice told me I needed to start a 401k again and make contributions. So I did. I followed that advice. I started a second 401k with the state. The state did not have matching, they didn't match your contributions. They had their own pension plan, and they did match that, but they did not match any 401k contributions. So this was totally on my own. Now, I contributed at least 10%, and I think I raised that over time to 12%, maybe 15%. And as I got closer to retirement, I upped the contribution to catch up a little bit, up to as high as 25% for a few years. At some point, my goals changed. So my goal, I will say this, I never once remember having the thought about our retirement savings that how can we spend the money on ourselves? That was never a thought in my mind. My mind went more to our daughter and now our grandchildren. How can it support them? And so I developed a generational savings plan. And I remember talking about it with my daughter. Now, I don't have a generational savings plan now because I realize that it's not really practical. Because, your child has their own mind, their own goals. They have a spouse, they have children. The grandchildren will have spouses one day, I hope, and their own children. So there are so many people involved that it's hard to build up a generational savings mentality. So I still think that's a neat way to look at it, but I don't know that it's practical for anybody, for that matter, me or anybody else. But I never did plan on using that money for ourselves, and my wife and I have we're living, our needs are paid for now in retirement by our Social Security, and our wants are covered by our pensions. So we both have pensions. So that's where we stand right now, and how our goals have changed over time. Originally, it was just to capture the match, and then I did without. I thought I had saved enough for retirement, and eventually I got back into saving for retirement, but it was for our children. All right, so that is sort of a brief history of my savings and what our goals were and how they changed over time. Let's go to the tabletop. I want to show you, the next question is, what is the risk of recession? And I've put some thought and run off some charts to show you what recessions and economic downturns I've experienced in my career and how I use that to help structure my portfolio now. We'll be right back. Okay, here we are at the tabletop, and this is some of the data that I prepared for you just to look at the risk of recession. And so I'll get into this. I hope you find it interesting. It is a lot of data, so I'll move pretty quickly. Now, when I say the word recession, but really there's three levels of downturn. There's a correction, which is generally 10%, 10 to 20%. A bear market is considered if it's over 20% and a fairly broad drop in prices. A recession is 2 consecutive quarters of declining GDP. So I use the word recession loosely. Sometimes it's more of a bear market or correction. But the most recent correction that we've gone through happened this year in 2025. And, this has been a good year overall. My index funds, S&P index funds, have gone up almost 17% so far this year. But if you think back, we had a period where we had a significant drop. It dropped 20%. Now this is the S&P 500 index that I'm charting because that's what I invest in primarily. But it dropped from its peak 20%, and it took 4 months to recover back to where we were before the drop, and then reach new heights. So that is the most recent one. And how do you remember that? One point I wanted to make is you don't know when the stocks start dropping. Like, for instance, when it reached this point, you don't know if it's a 10% correction or if it's going to go on to be a 20%, which it did, or whether it's going to be worse than that. And you don't know how long it's going to last. So you don't know that. You have to make your decision well in advance of this happening. You can't make it after the fact necessarily. Okay, let's go on to the next, which was fairly recent also. Now, I'm just curious what you think about the recession that happened it started December of 2021 and it ended December of 2023. I say recession, it wasn't necessarily, they kept debating whether this was a recession or not. It definitely was a bear market, but it dropped 26% from the peak down to the bottom, and it took 2 years to recover back to where we were in December of 2021. So that was definitely a bear market. The thing I remember most about this period of time is that I didn't check my stock accounts very often. Now I check them every day because it seems like every week we set a new record high with the S&P 500, but back then I didn't check it often at all. Okay, so we've had 3 economic downturns since 2020, and the first one was this one right here, which I'm sure everybody remembers. It was due to COVID, so the stocks, the S&P 500 reached a peak in February of 2020. It dropped 31%, so we've gone from 20 to 26 to 31%, so they've gotten worse as we go back in time. Dropped 31%, but the amazing thing is it recovered within 6 months, mainly because look at the steepness of this slope. They started printing money and putting money into the economy, and we recovered, but we had inflation to deal with now. So that price increase that happened during that period of time never went away. It's still out there in the economy. Okay, this graph shows 2 recessions. So there was the dot-com bust, if you remember that. I remember it very well because I lost a lot of money, a lot of stocks that went bankrupt in this period of time. And then the Great Recession. So the dot-com bust happened, it peaked in August 2000. We saw a 47% drop in the S&P 500, and then it took 7 full years for it to recover back to where it was before the recession. And then once it got there, it immediately went into the Great Recession, and we saw a 56% drop. So they've gotten worse as we've gone back in time. 56% drop, and it took 5.5 years to recover and get back. And that was in March of 2013. So if you add these together, there was 12.5 years from this point to this point over here. And when you got to this point right here, you had accomplished nothing basically if you let your money ride for this 12.5 year period of time. So just keep that in mind. And this is the time frame basically that I'm planning for. So this was fairly modern history. And we need to be able to survive a 10 to 12 year recession. Okay, so now I'm going to go back in time, and this was what was known as Black Friday. So this happened in August of 1987, and we lost 33%. The S&P 500 dropped 33% in just a very short period of time. A lot of that was one day on a Friday. And even though it happened so quickly, it took 2 full years to recover back to where we were when it dropped. So something that can happen, a very significant drop, can take a couple of years to recover. All right, so this is this might be the first major recession that I experienced. And this happened during my college years, which was during this period right here. But it happened in January of 1973 is when we peaked, and then we started down. The S&P 500 dropped 48%, and this was due to an energy crisis. And so this was during a period of time. My main memory during this period of time was getting in a line of cars to get gas, and everybody would cut their car off and push their cars forward one car length at a time until they could get enough gas. The gas was being rationed, and they'd get enough gas just to, drive that week or for a few days. Now, it took 7.5 years to recover from that initial drop, and it was July 1980 when it finally recovered. So I'd started with Boise Cascade in 79, and I worked for Weyerhaeuser in 77. So this was during my college years, the last year of high school and my college years, and then when I started work. Okay, I go back one more recession, or actually depression, and this is the Great Depression. So we had a peak, I didn't, but they did back then, of the Dow on September the 3rd, 1929. They had an 89% drop between then and the low, and I don't remember the date. I think it was July the 8th, 1932 is when they reached the low. And it didn't fully recover until November of 1954. So that was a 25-year event. Took 25 years to recover. That's a major thing that we hope that we don't live through again. All right, so these are the major recessions or economic downturns that we've had, at least in my life. And like I say, some were fairly minor. They were over in 4 months or 6 months. Others took 5 to 7 years to recover, and the two back-to-back, the dot-com and the Great Recession, took 12.5 years to recover. Let's go on to look at my portfolio now. Okay, so this is our current portfolio, and I've tried to come up with a hybrid approach of sorts. The green is cash accounts, and so the green is to have enough to weather any reasonable downturn, economic downturn that we might experience. And then this is stocks and property and precious metals, for growth. But if we did need money, here's how we would approach it. So this dark green right here, it is 2.7% of our total portfolio, and it's an emergency fund. So it's enough to cover us 1 to 1.5 years, depending on how frugal we want to be. It's earning very little interest, so I'm sacrificing on interest to be able to have this immediately available. So some people say they have 1 to 3 months of emergency fund. I don't think that's enough. I think that everybody needs at least 1 year of emergency fund. That's just my 2 cents on that. Once this is depleted, or as it's being depleted, we'll turn to this next piece of the pie, and this is 19.2%, and it's in CDs. So they're different lengths of time and different interest rates. All of them are at least 4%. But as they mature and as this is getting depleted, we would cash it in and move it over into cash. And I didn't mention it, but this is primarily in checking, savings account, money market accounts, that type thing. Now, if we needed to, so this is in U.S. Treasury bonds. They're in 3-month Treasury bonds. They're earning about the same as the CDs, about 4% or a little bit above. And so those would be available if we needed. So these all together are what I consider our cash accounts, and I think with these we could weather any economic downturn. If we needed to, we would turn to the stocks. The yellow is in stocks, and that's 58.8% of our portfolio. Those are in 3 different accounts with 3 different financial institutions. 2 are pre-tax. They're in S&P 500 index accounts, and then 1 is a brokerage account. So the largest one has 55% of our stocks. The next is 37% of our stocks, and then 8% of our stocks. The yield of these S&P 500 indices, they're not identical, and so their yield is a little bit different. So this one has 16.7% yield this year. This one had 16.6 this year. And if you want to look at a 3-year average, this one had 24.9%, and this one was 29.6% per year for 3 years. So we've had a series of really good years. Now, this little slice right here of gold is gold and silver that my wife bought quite a few years ago. I think she bought it over 10 years ago, maybe 15 years ago, on the advice of somebody she was listening to on the internet. And it's finally paying off. So time was on her side, and it's finally was a good investment. And this one is real estate, and it's in 4 properties that we either own or have interest in. And I wouldn't anticipate us doing anything with that other than selling some timber. So this is a hybrid account of sorts, hybrid by covering any type of economic downturn with cash if we needed it, and then the property, the gold, silver, and the stocks would be for growth, for long-term growth for our estate. Okay, so that's our current portfolio and my thoughts about recession. I think we need to be prepared for a recession with a drop in the S&P 500 of 40 to 50%, and maybe it won't recover for 5 to 7 years. That's just my thought. What are yours? Put your comments below. When do you think we'll have a recession? I know we'll have one. It's just how soon, and how severe will it be, and how are you preparing for it? I appreciate any comments you might make. Y'all take care. Bye.